Today, you'll find what are the best stocks to buy for the beginning of the new year. So you'll discover what are the 3 best stocks to buy right now in January 2023. To pick those different companies, as always, I'll start by analyzing what is the business model of the company, so how are they able to generate their income, and after, I'll make a fundamental analysis on each and every single one of these companies to see if they are really undervalued at the moment. The first company on my list for January 2023 is one of the largest technology companies in the entire world, which is Microsoft with the ticker MSFT. This American multinational, created in 1985 by Bill Gates and Paul Allen, was initially founded in a small garage of Alborough, and 40 years ago nowadays, this company worth over $1.7 trillion, and it is one of the largest companies in the entire world. This company is focusing in the creation of computer softwares, as well as consumer electronics, personal computers, and related services. Over the years, Microsoft has acquired over 200 different companies, with the most famous being Skype, Lincoln, Mojang, and GiftHub. And more recently, in January 2022, they have acquired a giant in the gaming sector, which is named Activision, for more than $60 billion. And over 2021, they have been able to generate over $168 billion of revenue, and the biggest part of it came from 3 main branches. First, you have the productivity and the businesses process, which group services and products developed to increase the productivity of different systems. For example, they have their famous star product Microsoft Office, as well as Lincoln, and this represents about the third of Microsoft revenue. After, another third of their revenue came from the intelligent clouds, which include the Microsoft SQL Server, Windows Server, and Azure. And the last third of their revenue came from their personal computer services and products, which is focusing in increasing the personal user experience. The best example, obviously, is Windows, but you also have different games from the Xbox and the Xbox consoles, as well as the search engine Bing. However, throughout 2022, after the restart of the economy that was massively stopped by the increase in the interest rates, this has had a massive impact on the valuation of Microsoft. Over the last year, we can see that this company has been down of about 30%. Despite that, what is really encouraging for this kind of company is the growing market in which they currently are. More precisely, the cloud computing and the gaming market. Only on its side, the Azure Cloud Computing branch of Microsoft has accounted for about 21% of the overall market of the cloud computing. And the average growth rate for this market is of about 69% for between 2021 and 2025. And with the acquisition of Activision for about $69 billion, they are gaining a great place in the growing gaming industry that currently worth over $170 billion. But now, let's see if this company is really undervalued at the moment. In terms of valuations, we can see that this company currently worth a whopping $1.77 trillion with a pretty fair price to earnings ratio of only about 25. Microsoft also had some pretty great profit and operating margin, as well as a great return on equity of higher than 42% over the last 12 months. For 2022, in terms of revenue, they have been able to generate over $200 billion with an increase of about 10% in their last quarterly revenue, but also with a decrease of about less 14% in their last quarterly earnings. But at the moment, this company currently sits on a lot of cash, more than $100 billion of cash, compared to only about $77 billion of debt. And in terms of the risk of this company represents by the beta on a 5 year period, we can see that this company is less risky than the average market with a beta of only about 0.93. But over the last year, we can see that it has fluctuated more than the market with a decrease of about less 30% of its value, compared to a decrease of about less 20% for the overall market. And we can also see that this company is giving a great 1.14% of dividend annually to their shareholders, with a pretty good payout ratio of only 26%, which means that this dividend is sustainable on the long term. And over the last 3 years, we can see that they have been able to increase their total revenue, which has also led them to increase their earnings before interest and taxes. And over that period, we can also see that they have been able to increase their operating cash flow, which has obviously increased their total free cash flow. Now Now for my second pick, I've went with AT&T with the ticker T. This American multinational acting in the telecommunication sector is currently the world's largest telecommunication company in terms of revenue, but it's also the third largest mobile telephone providers in the US. As a company that acts in the telecommunication sector, this business is providing some pretty essential services such as wireless network, cell phone, digital television, internet, and landline telecommunication services. All of these products and services have helped them to generate over $168 billion of revenue in 2021. And if you remember correctly, this is pretty much the same revenue in 2021 as Microsoft has been making, but with the difference that Microsoft worth over 10 times the valuation of AT&T, that is about $130 billion at the moment. However, don't be wrong, this company is excellent also for giving some incredible dividend annually of about 6%. And with the ex-dividend date that is the 9th of January 2023, it might not be too late for you to start a position in it. Plus, AT&T is also considered by many different dividend income investors to be one of the best blue chips to hold in your portfolio. In fact, in 2022, we can see that this company has been down of about 4%, which is way less compared to the average market that has been down of about 20%. So it can obviously be a great pick for you to hold if you want some stability in your portfolio. But now, is it worth your money? AT&T currently worth about $130 billion with a super low price to earning ratio of only about 7, which means that on that side, this stock would currently be undervalued. After, you can notice that they have some pretty fair profit and operating margin, as well as a great return on equity of about 12%. Over the last 12 months, we can see that they have generated about $155 billion of revenue. Unfortunately, in the last quarter of 2022, we've seen a slight decrease of about less 4% in their last quarterly revenue growth compared to the same quarter but last year, but we've also seen a slight increase of about 2% in their quarterly earnings. However, this company has only about $2 billion of cash compared to a massive debt of about $160 billion. But despite that, you can see that the 5 years beta is pretty low, only about 0.72, meaning that this stock would be less risky compared to the average market. And it is well represented by its slight decrease of only about less 1% over the last 52 weeks. And with their super high dividend of about 6% per year, you can see that they have a pretty good payout ratio of only about 55%. Unfortunately, over the last 4 years, we can see that they have slightly decreased their total revenue, but since they've been able to lower their total expense, we can see that there haven't been a big difference in their total earnings before interest and taxes. However, we can see that over that same period, it has also been reflected in the operating cash flow where they have been diminishing, which has led them to receive some lower free cash flow. And finally, for my last pick for January 2023, I've picked the Taiwan Semiconductor Company with the ticker TWD. This Taiwanese multinational semiconductor company is considered as the world's largest foundry in the entire world because of its valuation of over $300 billion. Acting in a very competitive market, Taiwan Semiconductor is creating, designing, and manufacturing different microchips that are after used for communication device, radios, television, medical equipment, as well as video games. We've recently realized the importance of those microchips in our life, especially throughout the COVID-19 pandemic where we had a microchip shortage which has led to have some massive impact on the overall economy, but which has also had a massive impact on the production of different equipment and accessories such as the electric vehicles. However, since this company is acting in a super competitive market, it means that often the profit margins are super tight. But in the case of the Taiwan Semiconductor Company, this is not really the case. In fact, they are able to get some super high profit margin compared to their US competitors. And this is explained by many different criteria. For example, the labor cost that is about 2 times more expensive in the US, but they are also able to save a lot of money in electricity fees. And all of this makes that this company is more competitive compared to some of their competitors. And it's why in the last quarter of 2022, this company had over 56% of the global foundry semiconductor market. And a good news for the investors is that they have said that they were increasing the sales price for their different microprocessors in the 1st of January 2023. Their profit margin might increase with that. And despite the geographical political risk that China invades Taiwan, well, in 2021, they have still been able to generate over $57 billion of revenue. And more recently, we've seen some big fund managers, just like Warren Buffett with Berkshire Hathaway, massively invest in that company, where on their side, they've acquired over $4.8 billion of stakes in that company. And the famous Vanguard International Stock ETF also have some massive stakes in that company, where it currently is the biggest holding in that fund. But now, let's see what the financial metrics are telling about that company. This company, that currently worth over $384 billion, has some pretty great price to earning ratio of only about 13, meaning that once again, this stock would be undervalued on that side. As I told you earlier, they have some incredibly high profit and operating margin of higher than 40%, with some great return on equity of about 36% on the last 12 months. With the Taiwanese currency, we can see that they've had some revenue over the last year of about $2.08 trillion, with some incredible quarterly revenue growth over the last quarter of 2022 of about 47%, and an increase of about 80% in their quarterly earnings. And on its side, we can see that it's a company that has a lot more cash compared to what is its current debt, and it's also a company slightly more risky compared to the average market with a beta of higher than 1, which is well represented with their 52 weeks change of less 38% over the last 12 months. However, despite that, we can see that they are still offering a great 2.37% of dividend per year, with a super low and a super good payout ratio of only about 32%. And over the last 4 years, we can see that they have been able to increase their total revenue, which has led obviously to an increase in their earnings before interest and taxes. And they've also had some pretty great increase in their operating cash flow over that same period, which has led them to receive some incredible growth in their free cash flow. Now that you find what are the best stocks to buy in January 2023, you might be wondering, hey, but Louis, what are the best ETFs to buy right now and hold forever? Well, in that case, check out the video that's gonna be right over here, and I will see you soon. Peace!